What if someone told you, right now, that the stock market you trust, the retirement funds, the index funds, the portfolios that millions of hardworking people have built over decades, is sitting on top of a time bomb? What if the person making that warning was the same man who predicted the 2008 financial crisis years before it happened, when every expert on Wall Street told him he was insane? Would you listen? Because Michael Burry is warning us again, not in a quiet way, not as a casual observation, but with the same cold, obsessive conviction that made him one of the most legendary investors in human history the first time around. And this time, the warning isn't just about mortgages, it's about something far bigger, something that touches every single person watching this video. This is not a video designed to make you panic. This is a video designed to make you think. Because the greatest investors in the world don't panic, they prepare. And preparation starts with understanding what is actually happening. So let's talk about what Michael Burry sees coming, and more importantly, what it means for you. Before we get into what Burry is saying today, we need to quickly understand why anyone should listen to him at all. Because here's the thing about Michael Burry. He is not a TV personality. He is not a motivational speaker. He is not someone who shows up on CNBC every morning to tell you what to buy. He is a deeply private, deeply analytical man who barely speaks in public. When he does speak or posts on social media, the financial world pays attention. This is a man who has been right when it mattered most. And right now, he is not quiet. He's alarmed. Let's get into the actual warnings. And the first one is something that will surprise you, because it is about something most people consider completely safe: index funds, passive investing. You have probably heard that the smartest thing you can do is put your money into a low-cost index fund, something that tracks the S&P 500, and just leave it there. Warren Buffett has said it. Financial advisors say it. It is the conventional wisdom of our era. Michael Burry disagrees profoundly. Here's why. Today, more than 60% of all equity fund assets in the United States are passively managed, meaning they automatically buy stocks in an index without any human deciding whether those stocks are fairly valued. Over half of all money in the market is just flowing in indiscriminately, buying everything in the index regardless of whether those companies are worth what they're priced at. Think about what that means. Imagine if everyone in a city decided to buy houses not because of the quality of the house, but simply because their retirement plan automatically purchased real estate every month. Prices would keep rising until the day people stopped buying. And then, with no fundamental value holding prices up, the collapse would be fast, deep, and devastating. That is exactly what Burry believes is happening in the stock market right now, and he warns there is a trigger approaching. Starting around 2028, the enormous generation of baby boomers will begin withdrawing from their retirement accounts in large numbers for the first time. For the first time in the history of modern index funds, the money will start flowing out, not in. And when that happens, Burry warns there will be no one left to buy. The second warning is one that will be even more controversial because it challenges the most exciting story in finance right now: artificial intelligence. We are living through an era where AI is everywhere. Every company is announcing AI strategies. Every tech giant is pouring hundreds of billions of dollars into AI infrastructure. The market is rewarding them with astronomical valuations. It feels like the future is being built right now, and anyone not investing in it is going to be left behind. Michael Burry has seen this story before, not with AI, but with the internet. In 1999 and 2000, everyone said the internet was going to change everything, and they were right. The internet did change everything, but that did not stop the dot-com bubble from wiping out 80% of the Nasdaq's value between 2000 and 2002. The technology was real, the hype was real, the companies were building real things, but the valuations were completely detached from the actual profits being generated. And when the gap between price and reality became too wide, the market corrected with extraordinary violence. He is not saying AI is worthless. He is saying that the prices people are paying for AI-related stocks today may not be justified by the actual earnings those companies will produce, at least not for a very long time. And then investing, paying too much for even a great business, is still a mistake. Here's the third warning, and this one comes with a historical chart that should make every investor stop and think. Burry recently shared data showing that American households now have more of their wealth locked in stocks than in real estate. That may sound like good news. People are investing. People are participating in the market. But Burry points out that this has only happened twice before in modern financial history. What happened after the first two times? Both were followed by prolonged, multi-year bear markets that destroyed enormous amounts of household wealth. Burry is not saying history always repeats exactly. He is pointing out a pattern, a warning signal that serious investors should not ignore. The deeper message here is about concentration of risk. When the majority of people's wealth is tied up in the stock market, when their retirement savings, their financial security, their future, all of it depends on the stock market remaining elevated, a crash doesn't just hurt investors, it devastates families, it reshapes economies, it changes lives. Now let's talk about something Burry has been watching more recently, and it reveals something important about how his mind works. In early 2026, Burry posted a chart comparing Bitcoin's recent price movement to the 2021 to 2022 crash. Bitcoin had fallen from a high of around $126,000 to absolutely $70,000. Burry overlaid this pattern against the previous bear market and suggested the chart was pointing toward a further decline, potentially into the low $50,000 range. He also warned about something specific, a collateral death spiral. Companies that had borrowed massively to buy Bitcoin and institutions that used Bitcoin as collateral for other positions could face a cascading chain of forced selling if prices kept falling. Each sale would push prices lower. Lower prices would trigger more forced selling, and so on, a self-reinforcing cycle of collapse. Now, some people push back on this. They said Bitcoin's situation today is different from 2021. They pointed out that institutional adoption has grown, that spot ETFs have changed the market structure, and those are fair points. Burry himself acknowledged he was drawing a historical parallel, not making a guaranteed prediction. But here's what matters, and this is the insight I want you to take from this section. The greatest investors in the world are not the most optimistic, they're the most honest. They look at what is, not what they hope will be. And that discipline, that refusal to be seduced by a good story, is what separates the people who build lasting wealth from the people who chase it. Now, I want to address something directly, because intellectual honesty matters more than hero worship. Michael Burry is not infallible, and I think it's important to say that clearly. Since 2008, Burry has made a number of predictions that did not come true, at least not in the timeline he expected. In 2015, he predicted a crash. The market rose 11%. In 2017, he warned of a global financial meltdown. Stocks returned over 19% the following year. In 2019, he warned about index fund bubbles. The S&P gained 15% in the next 12 months. In early 2020, he predicted a recession. Markets rallied sharply instead. Some analysts have pointed out that roughly 71% of his public predictions since 2008 have not come true as he expected or simply haven't happened yet. This is worth sitting with because it teaches us something important, not about Burry, but about markets themselves. What Burry's track record actually teaches us is this. The question is never simply, is this person right or wrong? The question is, are they looking at the right things? Are they asking the right questions? Are they identifying genuine risks that most people are ignoring? On that standard, on the standard of rigorous, independent, data-driven thinking, Burry's record is extraordinary. He doesn't always nail the timing, but he consistently identifies the fault lines before anyone else is even looking at them. So what do we actually do with all of this? Here's the thing I want you to understand, and this is the most important part of this entire video. Michael Burry's warnings are not a reason to panic. They are an invitation to think. There is a profound difference between those two things. Panic is reactive. It is driven by fear, by emotion, by the desperate need to do something, anything right now. Panic sells at the bottom. Panic locks in losses. Panic is what the crowd does. Thinking is different. Thinking asks, if there is risk here, how do I position myself intelligently? What do I own? What am I exposed to? Am I building a real financial literacy, or am I just following a trend and hoping it continues? The lesson Burry's entire life teaches is not be afraid of the market. The lesson is understand what you own. Read the details that others skip. Question the assumptions that everyone else is treating as facts. Build conviction through research, not through consensus. Markets will rise. Markets will fall. Crashes will come. They always do.
But the people who build lasting wealth are not the people who predicted every crash. They are the people who stayed informed, stayed rational, diversified intelligently, and refused to be stampeded by either greed or fear. Burry's warnings are not a roadmap for doom. They are a reminder to pay attention, to stay awake, to not sleepwalk through your financial life assuming that someone else has checked that everything is safe. Let me leave you with this. In Greek mythology, Cassandra could see the future. She warned Troy that the wooden horse left by the Greeks was a trap. She begged people to listen. She was ignored, and Troy fell. Burry chose that name for a reason, not because he's certain of what is coming, but because he believes there are things worth seeing, things worth saying even when the crowd is not ready to hear them. Whether his current warnings come true in 6 months or 6 years, or take a different shape entirely, the act of paying attention, of thinking critically, of refusing to be lulled into complacency by rising prices, that is always the right approach. The next crash, whenever it comes, whatever form it takes, will not announce
itself on the front page of a newspaper. It never does. It will come from the places most people refuse to look. If this video gave you something to think about, a new way of looking at the markets, a new respect for independent thinking, share it with someone who needs to hear it. And if you want to keep building this kind of financial mindset, this channel exists for exactly that reason. Stay curious, stay critical, stay ahead, and I will see you in the next one.